Hi there, I'm Bob Graham, President of Riggs Asset Management Company. Today I want to talk about a couple of big events we had this past week. Obviously everyone knows about the election, but the other big event was the Federal Reserve had a second meeting in a row in which they cut interest rates. So let's talk about what that means, that is the Federal Reserve interest rate cut, and then we'll talk about the election. The Federal Reserve met and they cut interest rates by 1/4%. Previously they had cut by 50 basis points, so we've seen 3/4 of a percentage point in interest rates cuts in, let's say, the last 2 months. That's a really big deal. And what the Federal Reserve said they're trying to do is get to what they call is a neutral rate, or what they defined as the road to neutrality. A little ambiguous, but let's try to put some context around there. It's really based off inflation. If you see an inflation rate of, let's say, as low as 2%, historically, the neutral rate has been somewhere from 1 percentage point or 1.5 percentage points above that. So depending on where we think interest rates are going to go, or where we think, inflation is going to go, we could see the federal funds rate pull down to a range of maybe on the high end, say 4.5%, and on the very low end, 3%. I think it's probably going to end up somewhere in there, but we'll find out. But that should get them to a more neutral rate, and that would actually benefit many organizations, many individuals across the country. Because as they bring rates down, what does that mean? It means that the auto loan is a little cheaper. Credit card rates maybe come down a little bit. The cost of a mortgage may come down a little bit. We're going to see how this plays out, but we're on this path. It's like we're going to continue to see short-term interest rates come down, and that should benefit smaller companies, individuals, as they have to go to banks or have to go to the markets to borrow money. And that should be good news going forward. Now let's talk about the other thing, the election. Obviously, that was a really big deal. And there are significant differences between the Biden administration and the incoming Trump administration. Obviously, people talk about things like tariffs. There are regulations that are going to be changed. We're probably going to see some type of tax change. The question is, how is that going to affect the markets? And I think we've gotten a hint of that, or at least a vision of what that could look like. And we got that the day after the election. We saw pretty significant pops in things like smaller companies. Those smaller company indices popped about 7%. We saw the same thing in mid-caps. By the way, larger companies, they did well too. But what you're seeing is the expectation that some of these new policies are going to benefit smaller companies. And different regulation, maybe a little tax difference, will benefit those companies. How does that play out in the markets? How does that play out against our long-term investment themes? Well, let's talk about things like artificial intelligence and the build-out of server centers and generative AI. Well, when you look at that, what do you need for that? We need incredible amounts of energy, of electricity. You need incredible amounts of really clean water. You need an infrastructure that supports that. Not just physical infrastructure, but technological infrastructure. All of those things are in place. But what would drive that? Well, what you may see is maybe the smaller companies that are fighting in that space, working in that space, do a little bit better because the regulatory burden on them is reduced. But the long-term theme is not changing. Let's talk about infrastructure. You can't drive anywhere in this country and know that, we've got an infrastructure that has to get rebuilt. And we're in the process of doing that. And those operations or those projects have been funded. If you go to your congressperson, if you go to your senator, none of those people want the bridge project in their district or their community canceled. So we see things as long-term themes that are going to drive U.S. economic growth. But what does the infrastructure mean? It means you still need, we're rebuilding airports, we're rebuilding terminals, everything from shipping terminals to railroad terminals. Obviously the road system, the bridge system, water pipes, energy transfer systems. Think about the grid as we have it today and where it needs to be in 5, 10 years. Not only to meet the growth in the economy, that's just sort of normal growth, but the amount of energy we need for artificial intelligence. All of these long-term themes are in place, but what we may see is that instead of being the largest companies in the United States, it may be some of the smaller ones. And this is a theme that could be with us for probably a couple of years. There are going to be changes. There are going to be drivers, but we're in an excellent position to take advantage of the markets and the changing economy as we see it moving forward. And I just want to say thank you. And if you have any questions whatsoever, please reach out to your RIGS team. We are here to help you. And one last thing, for all the veterans out there, I want to thank you and wish you a happy Veterans Day.